I understand that everybody, every person who has been presenting intervening and presenting a company has made a brief presentation of the company, and my intention is to do that, but just in a very, very brief way. I guess many of you are familiar with our company, but in any case, just to fulfill that little, let's say, marketing bit, we are a company that is, we like to characterize the company as a company with as a silo, a company with an integrated model. A model that provides a very balanced set of activities for the company, and that is allowing us to maintain a very stable result. By the way, satisfactory for shareholders, stakeholders, at the same time that we provide the services that we believe society requires from us. As you can see, we are in terms of, and this is a very stable, very stable, those figures are very stable since the company was incorporated in 2002. We maintain clearly a better return on equity than our peers. Our cost to income shows the efficiency of our business. We are very proud of that. We pay very high dividends. Our payout ratio goes between 80-something and 99%. And then we have this. We are very also very cost-conscious company, but we are very proud of this other parameter that, and we'll talk about this later, that the revenues that we have been developing, not linked to the trading volumes, are very high. Probably nobody in the industry has anything like that. That means basically, we'll see that later, that with no trade, not a single trade, and this is our main activity, other revenues are able to cover 117% of our costs. So this is a very lucky situation. But anyway, maybe I'll say something about what you were told in the program, something about how to move from national to international, something like that. Is that the point? Well, that has nothing to do with this. But so going to this point in the program, I would just mention 2 or 3 things that correspond to our case. Basically, I would say that we are quite international. In fact, very, very international. 70%, more than probably 75% of our activity, not in trading, but also in many of the other things we do, are done has a reference or takes place outside Spain. 75% of the trading comes from non-resident investors. But what I think would make a company or market to move from national to international is to have interesting companies, to have international companies. And how do you get international companies? Well, I only can tell you how we did it. It happened because, in many ways, because of the euro. If you have a currency that is, if you're in a country that doesn't have what I would call an international currency, the chances that your market is going to be very international are, I believe, more limited. So with the euro, the Spanish companies were able to become international companies, multinational corporations, together with the fact that some of these companies were being privatized, and the privatization process was clever, very well done. The result was that the free float of these companies, you know the names, Telefónica, Repsol, BBVA, Santander, or whatever, have millions of shareholders. I insist the free float can be considered practically 100%. And that was one of the reasons of why the market became international. If even now, clear example or clear evidence is that in Europe, I think the three most liquid stocks and the three most traded stocks, number 1, number 2, and number 3 are Santander, Telefónica, and BBVA. Repsol is number 6, and then we have our others like Inditex that is now number 7 or 8 or 9, something like that. So but all that comes from the fact that we have at the right time we could develop the financing of these companies in an international currency, the euro. We wouldn't have been able to do this with the peseta. And as I said, the privatizations or the IPOs were done in a very clever way, and they got a lot of a big free float. And then the thing that keeps that situation going on is that we provide the connectivity. I mean, we could not have 75% of our business coming from everywhere in the world if we didn't have a very efficient, fast, reliable, credible, or whatever technology. And our market data provision is also very efficient, and all these things. And also, to finish, you have to be also very transparent in the regulation in everything you do. Well, that was just a little interruption of my speech, because the purpose of my very brief speech today was different. Was basically to make a couple of comments. One of them about this: what's happening in the industry, and we have seen lately that, in particular, with this acquisition of, with the pretended acquisition of NYSE Euronext by ICE, that ICE is not interested in the European cash markets. Well, they have said that they will dispose one way or another of the cash operations. Yesterday, even heard that they were going to sell some Matif or something like that. No? But anyway, obviously, I have nothing to say about that decision. That's their business. But I take the opportunity to remind you, just in case there is a perception that cash markets are irrelevant or less relevant or whatever, that the equity markets, in my opinion, are essential providers of capital in our economies, and that role, together with the determination of credible prices that we do continuously for probably the most important and valuable assets in each economy has an enormous social and economic value that surpasses the role of the activities in other markets like derivatives, for instance. As a business, compare the cash business with the derivatives business over there, well, all this can be debatable. Because then you have other elements in question, like the management, the knowledge you have of the business, or whatever. So my point is just, with the occasion of this decision, where ICE is deciding to forget about a very substantial activity in Europe, I would like to say just this thing, that I believe and affirm that the equity markets play a very essential role. And this is even more clear when we look at this, in my opinion, very interesting table. This is what's happening in the world, and it's of particular relevance in this in the crisis in which we are still living, for a number of reasons. We are not going to go into that. That could take obviously a very long time, but the financing, banking financing has been consistently much relevant in the European markets than in the US, for instance. So as you say, the extremes are Spain, where market-based financing is only 20%, and the US, where market-based financing is 80%. Well, my point is that at this particular time, with a clear and necessary deleveraging in the economy, when banks are going to reduce their sizes, there is a very, very clear opportunity for the exchanges to make progress in advancing their business in equities and non-equities, and helping to change a financial structure that has proven to be not the best in our times. Clearly, I'll repeat that later, but the contractual, the excessive debt. In fact, this is a proof of the excessive debt in the economy. But the contractual nature of debt imposes a structural rigidity that then makes very difficult the potential systemic adjustments that are necessary in the economy at certain moments, like now. Anyway, so my point here is that all this is a measure of the potential of the market-based economy vis-a-vis the market-based financing vis-a-vis the bank-based financing. I think the exchanges it's very difficult. It's very difficult, and you have to analyze the possibilities in equities and in debt and things like that. But the potentiality is enormous, and this happens at a historical moment when we are all convinced that this bank financing is excessive, and this is because it's clearly related to the excess of debt that we have in the system. Anyway, going back to also having reading the papers a little bit, there you have something that appeared in The Economist recently, and with a very lucky, in my opinion, a very lucky sentence there. The stock market is good if it enables companies to raise equity or real financing. That was a reference to India, but I bring this just to insist a little more on this relevant role for the economy of the equity financing and the mechanisms that facilitate that financing, like cash markets. In that article, they talk about how India could easily absorb 50 to 100 billion dollars of equity capital. And I use this to remind you that in 2012, the last year, the financing provided by stock exchanges at world level, the equity financing provided by stock exchanges at world level exceeded it was more than $621 billion, which is quite a big figure. By the way, the London Stock Exchange, together with ourselves, BME, were the largest financiers in Europe, with amounts reaching in a difficult year around more than 30 billion euros in 2012. That would be that would be a second position in the world, and fifth for investment flows facilitated to the economies. The relevant thing is that the big flows, the big financing took place in Asia, in the Asian markets. Well, in fact, what I have been trying to say in these 2 or 3 comments I made is that probably, given the situation in which we are, the recognition that this disproportionate growth of global debt and the nature of the contractual nature of debt imposes difficulties and structural rigidities in the markets. I think that is clearly the time for less debt and more equity. Here, I repeat, this is the same I have been trying to say before. There's clearly a very good window of opportunity for equity exchanges. But it's not easy, it's difficult, but it should be, and I think we are all working on this, it should be tried, and it would be good for everybody. And so that was one point. And the other point, another observation, is what our friends in NASDAQ, going back to, that's the only thing I do, I read the papers. That my friend Bob Greifel said the other day, something like, it's there. How we made our money in the past will not be how we make our money in the future. Okay, I probably agree with that. But I think I bring this because I think this is a pattern that we are going to see more of this in the future. But the key is that at the same time that we do that, even if we could call this diversification, but certain type of diversification. We are not going to go into gas stations, things like that, right? We should do things that are that help us to maintain our key role and that are close and favor the real economy, not things that are disparate things or whatever. Anyway, I agree with that, and the only thing I'm happy also to say is that, as I said at the beginning, with that type of diversification, we have been working on this since practically we were founded, or we are in existence, and this is one of our strengths. As I said, nobody has this situation, no company, no competitor has this situation so favorable. But this has been one of our features, and that we are very proud, and I think we are achieving what we wanted. I hope we will be able to continue. But it is true what Bob Greifel said, only that we are a few years ahead of Bob. That's okay. Anyway, thank you very much.